Every day, the world moves on as it always has. Cities wake up, work begins, and life feels familiar. But beneath that sense of normality, something is shifting. The climate is changing, and the systems we rely on, energy, food, water, cities, finance, are under pressure in ways we're only beginning to understand. These changes don't live in reports or projections, they are already shaping people, livelihoods, and communities. We created the Climate Leadership Podcast so these challenges don't remain abstract or distant, but are explored through the people working inside these systems, making real decisions with real consequences, often without clear answers. This is not a space for fear, blame, or perfection. It's a space for honest conversations about what leadership looks like in a changing world. If you're listening, you're already part of that leadership. Let's begin the conversation.
Welcome to another episode of the Climate Leadership Podcast, a show where we explore how capital, markets, and leadership respond to climate change through real decisions, real constraints, and real-world outcomes. In this episode, we focus on one of the most urgent and under-discussed frontiers in climate finance, mobilizing private capital for climate adaptation. As the world moves towards 2.5 degrees Celsius trajectory, adaptation is no longer optional. It is inevitable. The question is not whether we will spend on adaptation, but how capital markets will respond. My guest today is Mr. Darren Clifford, Managing Director, Investor, former leader at McKinsey & Company, and founder of Adapt Capital. Over the last 15 years, he has scaled ventures as a founder, investor, and venture builder, delivering strong financial returns while focusing on businesses built for a hotter, harsher world. In this conversation, we move beyond net zero narrative to examine what it truly takes to attract serious private capital into climate adaptation markets. Thank you, Darren, for joining me today.
Thank you for having me, and I'm excited to be here.
Okay, so let's get started. You often speak about building businesses for a 2.5 degrees Celsius world. From an investor's perspective, what fundamentally changes when we accept that trajectory as a base case?
Well, I think it's interesting because when you look at building a business and investing in a business, traditional VC, we look at like, where's the market size? Is there going to be growth to this business? How does the fundamentals in the business case work? And what you just need to do is adjust that for the fact that the weather is getting hotter and more volatile. And so there's going to be some areas where we're just going to see that, it's going to be a lot tougher. If you're building a business around skiing in some places in California, it may not be quite the same ski season that you're used to.
Mm-hmm.
On the flip side, there's other places where the demand will shift and it'll actually be growth. And so air conditioning, air purifiers, things like that. So I think the fundamentals are the same. It's just about where the demand is actually going to be shifting to as the weather gets hotter. And then you need to go and allocate capital to that. Because ultimately, as an investor, I'm just looking at returns and risk, and I'm trying to manage these things to be able to find the best place to be able to get the returns on my money in a way that also manages the risk with the rest of my portfolio.
Right. Okay, so climate mitigation has dominated capital flows for years. Why do you believe adaptation markets are still undercapitalized despite growing physical climate risks?
Well, I think you get, especially in today's world, the people who have been focusing on climate mitigation tend to be people who really are out here to try to solve the problem and do what's best for society with that lens of just, we have to make sure we get to the underlying approach. And I think actually that's great and it's true. The challenge is it's not the only thing we need to do. So what I don't want to come here and advocate is that we should be doing adaptation instead of mitigation.
Mm-hmm.
This is an and story to me. We need to do both adaptation and mitigation. And I just argue that adaptation relative to mitigation is underfunded because it's not as sexy. You're not solving the problem. If you're approaching this from an impact lens, you generally want this impact to be that we're solving the problem and I can really go home and be proud of how I talk to my kids and my family and what I'm doing to say, yes, this is a valuable thing to do. Where adaptation is, yeah, it's just making sure that we can live a better life even as the world gets hotter. It is impactful, absolutely it is, but it's not as sexy. And so it doesn't get the same type of impact dollars. And then when it comes to the for-profit dollars, the challenge there is it oftentimes ends up being quite short-sighted. So it's what is it right in front of us? What is the most urgent and impactful? So I understand how for-profit dollars right now are focused on AI because that's going to be a revolutionary shift for the world. Though I don't think you're going to be able to make that much money there as an investor. I see how it's focused on defense, as right now there's a big push for defense spending. That can shift as the political situations shift across the globe. I get this idea that there's even a desire to invest in space technologies, as what we're seeing with the coming down of cost through SpaceX and being able to access space more. That opens up things. But a lot of this is just what's immediate. Where unfortunately, if you look at the most infographics and posts you see about this, climate is not urgent, but in the long term, it is the most impactful. And so it's just it's the urgency that's really is the thing that's stopping us from getting for-profit dollars. And then it's the sexiness of the relevance of, can I say I'm solving the problem, that's stopping us from getting the impact dollars.
Right. Darren, I was also thinking, like during our class on adaptation, we were talking about raising money for third world countries, as they put it, like, adaptation in Bangladesh, adaptation in Sri Lanka or Indonesia or India. So raising money from the first world European countries or US to put that fund in those countries, I was thinking people might think, like, why should my dollar go there? What do you think about that?
Well, look, I'm a pragmatist, and I'm a believer in self-interest, and that, with the best way, like even if you look at technologies like wind and solar, they're not examples and stories of sustainability, green solutions, being able to scale across the world. They're stories of the lowest cost solution scaling. So I think the best thing that we can do for the low-income countries in the world is actually create and develop new, better, cheaper solutions, so that way the cost of actually implementing them is lower, and that will lead to adoption and improve the resiliency for humanity. So I'm not a big believer in just going and investing the money there. I think you have to figure out, like, what is the problem you're solving. If you think that it is a problem that the people in a low-income country just don't even know what the solution is, I do struggle with that, especially going forward in a world of AI where information just becomes so readily available. I was in Colombia last year and talking to someone who wanted to start a business, and it's like, why don't you just go to ChatGPT and ask it how to start this business? And they're like, oh, I never even thought of that, and now they can. And they can get a bunch of ideas. So I don't think it's going to be knowing the solution that's going to really be the difference maker anymore. I think it really is just that we're at the economic frontier. People are putting in solutions that they think is the best thing to do, and that's what we have to shift. I can buy the argument that if you're, like, in economic development parlance, if you're a Piketty versus Jeffrey Sachs believer of, is there a poverty trap or not, maybe then you could sit here and say, I'm doing it because of the poverty trap, but then why you're doing it, right? From a pure economic, like, self-interest, how do we actually get this done? The single best thing we can do to get resiliency in low-income countries is solve poverty, followed by bring new innovative solutions to the marketplace that are cheaper, so that way people can actually apply them.
Okay. So when you evaluate an adaptation opportunity, what signals tell you that real durable market demand exists?
Well, the fortunate thing, is we look for demand that's there today, right? So whether this is something like air conditioning. Air conditioning is already, well above $100 billion as a global marketplace. It's just growing faster than global GDP is, right? And so now you're saying this is a massive market here today and already growing. I think if you look at building like siding materials for resilient materials, it's a massive market. It's already growing. Even something like coastal erosion. You look at some of the states like Louisiana in the US, they're spending a bucket of money on coastal erosion already today. And so, at least as we invest with a sort of 5 to 10 year horizon that we're sort of looking through as VC investors, we do need to see that there's some demand for the product already. It's a little bit too early to invest in training ocean-going crew members on Arctic passage voyages in the hopes that the Northwest Passage will open. We're probably a few years early for that, so I wouldn't invest there because I don't see the demand already. But there's already so many places that the demand is present and it will keep increasing, whether it's from cooling wearables or backup battery systems. We're fortunate you already look for things that appear to be.
Okay. So many founders say they have strong climate solutions but struggle to raise funding. What are they missing when pitching adaptation businesses to private investors?
If you look at like when we're raising money for our fund, it's 29 pages of why you will make money and it has a favorable risk profile. And in good Steve Jobs fashion, I go, oh, and one more thing. We improve the quality of life for humanity. Go back to what I just said about wind and solar. My fundamental belief is, unfortunately, at scale, the market doesn't care about your impact. The market cares about, are you better, faster, cheaper? And so when you have this great climate solution, it's not a great climate solution unless the economics work. We're looking for the next LED light bulb. The LED light bulb was cheaper, has made a bunch of people money who came out and actually developed it. And guess what? It used less electricity, there was less waste, it lasted longer. Everyone won. That's what we try to go and look for because we are believers that we're early enough that we can still find these companies. And it truly is the economics that's going to lead this. And if we get the economics right, and the company, even like great economics and a little bit of impact, if we can scale that, we'll still have the impact that we want and will.
Okay. So you have said you lead with returns, not impact. It is a co-benefit. Why is that framing essential if we want institutional capital to enter adaptation markets at scale?
Well, this is what I've been alluding to so far, right? Like my understanding of the numbers is there's about $300 trillion of investable capital in the world, and something like 1.5 trillion of quote unquote impact capital. Of that 1.5 trillion, still around 80% of it asks for market rates of return. So you look at this and go like the amount of capital that actually is willing to say, I am willing to take some sort of appropriate rate of return or concessionary rate of return, maybe about $300 billion. It's just not that much compared to the rest of the capital that's out there. And so it really is then that if you want access to capital from an investment perspective, you have to speak their language. You have to talk the same way that they do, as that's the way that you actually be able to get the capital that you're seeking in the marketplace. I think part of it then comes back down as a company, if you're trying to raise, is be clear about what you are. I think one of the things you can focus on is like, am I a for-profit company where the economics really are favorable and that's what I am and I will try to raise money accordingly? And the fact that I happen to be impactful is great and that will open up a few additional investors for me, but I'm a for-profit company. Or the alternative is recognize that you're some form of non-profit, like reduced economic company, in which case go and find that small pool of capital who does believe in the impact, lead with talking about the impact, and then your one more thing, right? You do 29 pages of impact and do one page of, oh, by the way, we get okay returns, right? Like it's going to be half of what you would expect the market to deliver, but we're going to be sustainable. And so we're like, but that's truly just the added benefit of our solution. If you are impact first, I think be focused on impact first, try to attract those pools of capital, use the fact that you are still profitable in some way as an added benefit versus people like me we believe in being for profit first. We optimize for profits. We just have a constraint in where we invest, that we only invest in companies that improve the quality of life for humanity.
Right. So, Darren, I'm thinking, are there a lot of companies that can achieve that, like a lot of return and plus the impact?
Yeah, we think that there are plenty of companies. Go back to some of the things that I've just been telling you, whether it's from frost protection, paint on insulation, coastal erosion, air conditioning, air purifying, resilient materials, backup battery systems, cooling, wearables. I'm looking at startups in all of these spaces. There's a ton of things out there, and in each of these spaces, it's like what we did. We made an investment in an air conditioning company. We did a due diligence as part of that around the social impact that it creates, and it was clear. It was like you're talking about doing air conditioning 20 times more efficient than existing air conditioning. Yes, this is impactful, right? And I really didn't need an outside view of this. It's like if I can bring air conditioning to the market ridiculously cheaper, that's going to be worth it. If I can bring a cheap air purifier to the market, that's going to be impactful for society. We really try to focus on there's a number of places where you really know right from the beginning if you can do this and make the numbers work and make it actually be the low cost provider, you will have a lot of social impact. Right. I'll give you maybe a bit of a counterfactual story. I was in Colombia and I was talking to a fund in Colombia that invests in hardwood in the back country of Colombia. They were creating jobs for people in the back end, like in the rural areas, growing trees that they would then be able to produce into hardwood and export. And I go to talk to them and they bring in their head of impact because they want to talk to me and tell me everything that they're doing around the impact they're generating. Mm-hmm. You're growing trees in Colombia, making rural jobs. I don't need to do an analysis. I will give you impactful. Right? I don't need to measure it, whether it's a ton of impact, a lot, you don't need to convince me of that. It's fundamental in what you're doing. What I need to know is, are you a charity? Mm-hmm. They want me to invest my money. An investment implies that you'll give me a return on it. Mm-hmm. If they came and said, donate your money, I would then go, oh, tell me all about the impact. But when you say invest my money, you have to come and actually prove to me that you will be able to at least sustain yourself. You won't be coming back and asking me next year and the year after and the year after for more money to keep going. Mm-hmm. Right? And that's the companies that don't understand who they actually are not communicating effectively about what they are, come across as just unconnected to the person that they're talking to. You're either sitting here and saying, I'm here to be able to make money, and it happens to be I improve society. Great, you can go and raise capital for investments. Or you are impact first. You may happen to make a little bit of money, in which case, use that as a benefit as you go and try to attract philanthropy dollars.
Okay, so in this case, Darren, there is a big chance of greenwashing.
Yes.
When companies claim they do stuff, but they can't prove it.
To a point, yeah, right? The idea, so going back to this example company in Colombia, right? As long as they're actually bringing their hardwood to the market, and I can see at some point wood is coming to the market and being sold, right? Do I worry about how much impact that they're saying and whether they're skewing the numbers a little bit or not? Not if I have some pictures of here's the people planting trees in Colombia, here's the local trees are sold and there's revenue being generated. The market tells me that you're actually getting some revenue, so you're selling something. In that case, they may be overselling their impact. I really don't care, right? I care that it is impactful. Let's do more of it. Let's keep going. And that's just like our view is I listened to Warren Buffett speak years ago, and of course, phenomenal. And it was a room full of MBA students, and Warren Buffett says, I don't employ a single financial analyst. And every MBA student's just, oh, that's the job I wanted, was financial analyst at Berkshire Hathaway, the dream job. And he went, it's very simple. If I look at an investment and it's 8, 9, or 10% returns, and I need a financial analyst to figure this out and put a big Excel model together and think about interest rate risk, and it's going to come out to 8.3%. Now, should I do the investment or not? The answer is simple. He doesn't do the investment. There's no sense. On the flip side, if he looks at an investment and says, I'm not sure if it's going to be 15, 20, or 25% returns, the answer is simple. You do the investment. I don't need a financial analyst to say I do this. Like, we'll see how it all works out. But if it was 18% returns, great. If it's 20, great. Like 25, even better. Right? You go and you make the investment. I think about the same thing with impact. Right? Like, I'm looking for the places where it's pretty obvious. Right? If we can prevent coastal erosion, I think it's pretty obvious that that's a beneficial thing for society. Right? I don't need to sit here and worry about, are people greenwashing up, when the fundamental part of the business of what they do is improving, like, beneficial for society. What I need to know is, will they make money while they do it, so that they can scale it and keep doing it for more people.
Okay, understood. So, what role does catalytic capital plays in making adaptation funds investable for commercial LPs?
I think that we're in a space where, because something is new, there is some, question around going back to these different pools of capital. Within the for-profit pool of capital, there's a group of people who, as I said, just worry about the immediate. And since adaptation isn't the immediate, there's a question of like, wait a second, in that group of for-profit capital, the people who worry about the immediate are not going to be interested in adaptation. There's a smaller pool of people there who are like, no, I'm long-term patient capital because I look at where markets are going to be 5 to 10 years from now. Those are my people, right? And so the role of catalytic capital is generally around being able to help these two bridge each other. Because by someone coming in and saying, you know what, I do recognize that this is a place that you can have profit. It has to be able to prove that it has profit. But one way I can get more capital into space, because I do believe that the impact that goes with it, is to do things like, hey, we will take the marketplace for the companies you're investing in and help ensure that that market actually develops. Right? This is a big thing in adaptation, because adaptation has a struggle when they commercialize their technologies, that it's often a loss avoidance business case. And so to help people do what's in their own best interest by making the business case for loss avoidance even better, you'd see more adoption of it. And this would increase the resiliency for humanity. So you can help with the portfolio of the end markets of the companies that like you're investing in. You can help in the portfolio of companies that people like me invest in, where you're like, look, you're bringing air conditioning to the market. You're going to do this 20 times more efficient. That's a huge thing to be able to improve society. How do I help provide you a grant or non-dilutive funding or something of that nature? All the way to looking at like a fund like myself and actually saying, hey, Darren, we'll invest in your fund on the grounds that you'll be able to go and raise more capital based on our investment, and that will unlock more things in adaptation. So I think catalytic capital has a great opportunity that's here. On the flip side, I do believe that if you give it time, the market will sort this out. What I mean by that is, like, in 5 to 10 years from now, the weather keeps getting hotter, more volatile, more people will be shifting into adaptation anyways. The whole thing is catalytic capital can make this happen earlier, can make this happen first, can make it happen better, right? It's going to be an accelerant, but it's a huge unlock if you think about it through the impact lens. But as I've been arguing here, through the for-profit lens, I think this space will eventually get there itself. It's just catalytic capital make it get there much quicker.
Okay. So next thing is about blended finance.
Yep.
So blended finance is often discussed but rarely understood. In practical terms, how can tranche structures unlock larger pools of private capital?
It really is like the blended finance whole approach is about changing the risk reward trade offs and therefore changing the value proposition of an investment. And the idea is that the people who care about impact tend to be willing to take on more risk. So they do that, right, in order to also attract larger pools of capital. And so the blended finance approach is a way of getting leverage on the like concessionary capital or philanthropic capital some way, or else it can still be for profit, but people who are more impact focused first. And so it really does come in and is relevant when you slice up the risk, which is oftentimes a huge basis of what adaptation technologies are. Adaptation technologies are about risk mitigation. And so I think it's a cute little corollary between blended finance, which is about changing risks, and adaptation technology, which is often about changing risks. It's just about who it's there for. So I think there's quite a role that's here. But it really comes down to, I think at least, getting this started and showing and proving that you can actually make money in this space, and then the rest of the capital will follow.
Okay. So carbon markets have created regulated pathways for mitigation finance. Do you see similar structures emerging for adaptation, or will the market evolve differently?
I think it's going to evolve very differently. So one, I think the challenge, what carbon credits are trying to do is get you to internalize the externality of the cost of carbon and what you're doing, and be able to either get benefit from it because you're there. It's trying to solve this externality problem. Adaptation isn't going to have that same externality problem. It really is going to become, it's in your self-interest to adapt. It's a very personal thing. It's what are you going to do differently as the weather gets hotter and more volatile. So I don't think we're going to need carbon markets, and I'm thankful for this. One other thing I'd add here is all portfolio companies that I think about investing in, I would never get them to say, I'm an adaptation technology. Because no one buys adaptation. People buy cooling because they want an air conditioner because it's freaking hot, right? They want air purifier because there's forest fires going around and they can barely breathe in their home. So I'd ask all the companies to always brand themselves as the problem that they are solving. I happen to now as being the person who's putting the pool of companies together that are all solving a common problem around meeting the demand that's caused by hotter, more volatile worlds, having these loss avoidance business cases that they share, having to go international early. I can brand myself as an adaptation fund. But it's very different, as now I can sit here and create this as a unique opportunity to go and invest where the investors can get alpha, beta, and have impact. It's really unique that way. But I don't think that you're going to need carbon credits. I wouldn't say that there's going to be an adaptation startup space. It's going to be much more around cooling. It's the infrastructure and the part of infrastructure where the heat increase causes demand shifts.
I see. So companies are more problem focused, which is coming up with heating of the world. Yeah.
It's being customer focused. We always ask a startup to build from a customer back. What is the pain point you're solving for the customer? So they should be talking about that pain point that the customer faces. That's what we want them to focus on. I am doing the same thing. I am building from my customer, which is the startup, and I'm working from them backwards. It's just the commonality of my pool, my customers, is the fact that they are adaptation technologies. They're generally strong technical founders with weak business building acumen. They're founders of companies that need to go internationally earlier, face the loss avoidance business case. So it's just a little different like that way. And the pool, it makes sense for me to pool around this sense of adaptation, but I wouldn't ask our customer or our companies to.
Sure. So thank you, Darren, for sharing your experience and conviction on mobilizing private capital for climate adaptation markets. This conversation highlights that adaptation is not a side strategy to mitigation, but a rapidly emerging economic reality. For investors, founders, and policymakers alike, the challenge now is to align capital with inevitable demand in a warming world. Thank you for listening to the Climate Leadership Podcast. If you found this episode valuable, follow the show and share it with others shaping the future of climate finance. Until next time, take care and have a nice day. Bye-bye.
Thanks.